Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. Very excited for today's show. We've got two-time guest Chad Schieler with us today. So, Chad, welcome.
Thanks, Brian. Glad to be on. See you again. This is
Yeah,
awesome.
good seeing you again, too. So, we're going to still go over your history. We're going to pretend you haven't ever been on the show before because we are doing a different format. So, we're just going to start where it all begins. And Chad, do us a favor. Tell us about yourself.
Yeah, thanks, Brian. I'm an apartment investor here in Indiana. Been doing this for about 4 years now. Before this, I was in the electronic payments industry for about 18 years and did, fairly well at that, and decided about 7 years ago I wanted to do something different. I wanted to do more of my life. I want to get into real estate. Spent 3 years over analyzing everything, looking at a lot of properties, and took 3 years to do that, and finally bought the first deal in 2021, bought a fourplex.
Okay.
Made all the mistakes I could have made, and then kind of went from there to now we're focused capital and got a team of people here, team of four right now. And so been a
Yeah.
fun journey though.
Yeah, fun is a pretty good word to describe it. You never know what's coming up around the corner, and for me, it's always like a roller coaster. When I was sitting in my day job, looking about the apartment investing industry, I'd liken it to like sitting in the roller coaster line as a 10-year-old kid, and just thinking, do I really want to do this? It looks fun, but I don't know. Anyway, that's the analogy that always goes through my head.
Plunge.
But you just got to take the plunge, sit in the seat, put that lap bar down as tight as you can and roll. But let's dive a little deeper in there. Tell us about, a little bit about your, not necessarily what you did, but kind of like your life situation, when you were in the electronic payments field, and why you started looking on the other side of the fence, why you're looking for greener pastures.
Yeah, I would say the main reason why is I knew I had a lot more in myself, that I could do a lot more with my life and my career. And I had a lot of drive,
Yep.
and I did very well at what I did previously. I'm not gonna lie, it was great opportunity and great residual income. And I knew that there was something else that I could do that could benefit the communities. I could make an impact. I could really use my God-given talents in more ways. And I just had this drive to kind of do more with myself. I got my first taste of real estate when I actually passively invested in one of my buddies' two development deals, and based there, and as a LP limited partner, and kind of
Mhm.
saw that went, got paid out after a couple of years, made 27% of my money each year. And I was like, wow, this is pretty cool.
That's a good number.
And read that purple book, Robert
Hmm.
Kiyosaki, right? Where's
Yep.
that poured at? And then I was like, wow, light bulb turned on. And I spent the next, 3 years, just reading books and podcasts and coffee meetings and bugging the heck out of people, asking them questions and being annoying and looking at properties and down rabbit holes and rabbit holes. And then, yeah, I just finally had to just buy a property. I remember the one day it was like, I kept getting outbid on properties.
Hmm.
And Saturday morning, 8 o'clock, this fourplex popped up in the MLS. I had
Hmm.
seen properties there in the same street in the past, and I not won the deal. So I decided, you know what, I'm going to get this deal. If it costs me more money, I'll get the deal. So I offered 10K over asking for it. I
Hmm.
said, you get 3 hours to respond. I waived the inspection. It was fully vacant, like all the warning signs, right? But of course, offer accepted, right?
Yeah.
But going back to your question, again, rabbit hole, sorry.
Yeah.
I did this just because there's more out there. I was driven to do more of my life.
Yeah. Yeah. I love it. I love it. And for me, it was similar. I think there was a time where, I mean, most people know I was active duty Marine, and there's a lot of good things about that. There's a lot of intangibles that you don't see on that paycheck that comes in. But I was winding down that career, and it was exactly the same. It's like, okay, I don't want to go into a normal job. I was seeing all of my peers, they would retire and they would show back up, hang their uniform up and show back up in a business suit doing the same job. And I was in the same boat. It's like, I don't want to do that. I want something more. Let's dive into this fourplex a little bit more because I think that's super interesting. You're syndicating now. Did you know about syndications when you put this fourplex together, or when you bought the fourplex, or why the fourplex at this point?
Yeah, I had heard the word syndication, but to be
Yeah.
honest with you, I had no idea what it meant.
Okay.
I just had never looked into that at all. And my thought was, I'll make mistakes on these deals up front. I
Yep.
prefer to use my own money first before I use investors' capital.
Mhm.
So I took the very hard road of doing my first four deals myself with my own money.
Mhm.
I didn't raise money to my fifth deal. And that's not the road most people take. But I'm glad I did that. I'm glad I am because I made a lot of mistakes and they're out of the way now and I can, raise capital going forward.
I think a lot of people go through that same mindset, that same, I'd rather lose money with my own. I'd figure it out on my own first. And I was doing the exact same thing myself. It was the same thing. It was just like, hey, if I'm going to do this, I want to be able to do it right. I want to be able to, take all the risk with my own money first and then move on. I think that's a very natural progression.
I did 4 deals myself, did a 4 unit, then a 15, then a 20, then a 25.
Wow.
Then I went through some coaching programs and realized, oh, wow, this is syndications, whole different world opened up there. And then I went to my first syndication of 67 units
Mhm.
and then formed Focus Capital and did, 3 more deals at that point in time.
Awesome. So going through these deals that you did, they progressively get larger. Were you selling them and doing like 1031s, or were you just putting more capital in? How did that progression work out for you?
Yeah, so the 4 unit, I bought that, and then that was March of 2021.
Okay.
And then I bought the 15 unit in November of 21.
Okay.
And then I bought the 20 unit in March of 22. And then that summer, my 4 unit I first bought at the very beginning was doing pretty well. And I was getting tapped out on time. Like I still
Mhm.
had a full-time job
Mhm.
and I was managing 39 doors. I had a PM company, but I ended up selling the 4 unit off market
Mhm.
for I doubled my capital on that deal. So I did an exchange on that deal into a 25 unit property with no extra money in the deal at all. I traded the property into that one. That's how that worked. It's a pretty cool deal.
Yeah, it is nice when it works like that. And I think the timing worked well because if I'm putting the timeline together, that's probably right about the peak price for selling that property.
Yeah, I mean, 300K, it was the right time for sure.
Yeah.
Yeah. Off
Um,
market too.
yeah. I mean, it also means it was peak price for buying the new property.
We paid 30K a door for the 25 unit. It was off market from the seller too. So we got a pretty good deal there in the exchange. It's
30.
doubled in value in the last couple of years. Yeah.
I didn't know that even existed anymore.
It was built in 1930, so a little older property.
I mean, I have bought a couple at 30 a door, but they're off the beaten path in South Carolina. It's kind of have you ever heard the Jeff Foxworthy You Might Be a Redneck series?
Yep,
Yeah.
yep.
Yeah. If the directions to your apartment complex include turn left on that dirt road, yeah, that's kind of the properties that we picked up at 30 a door. But yeah, it's hard to beat 30 a door. So you ended up with that 25 unit. You say you got into a coaching program and then from there jumped into your first syndication. Why syndicate? From that point. I mean, you had a bunch of units. I'm assuming they're cash flowing, but why
Yep.
go from, self-operating, and by this time you had 60 something units. Why move up?
Yeah, well, I knew I wanted to do larger deals. I knew that the larger deals would be easier to manage. I'd experienced the pains of smaller deals with the PM companies. It's hard to find great management companies in this area, and probably a lot of areas for that matter for mid-sized properties between, well, under 100 units.
Mhm.
If you can't have on-site payroll, it's going to be pretty tough to get somebody to show the attention on the property all the time that you need. So I knew I had to do bigger deals, and I knew that to do those, I couldn't use my own money. I didn't have enough to do the bigger deals, so I had to raise capital, and that's why. I mean, I didn't actually raise capital first. I found a couple partners raise capital for me, went through that process, and then the next deal decided to do it myself and raise capital and learn that whole process on my own.
Awesome. That's something that comes over and over again. People ask me why I syndicate instead of buying stuff by myself or instead of buying JVs. And similar answer, it doesn't matter how much money you're starting out with. Eventually you run out of money. We're buying a $20 million property with an $8 million capital raise. Could I do that by myself? I mean, even you started out with $8 million in cash, you buy that one and now it's, out of Schlitz. So
Well, you look at your velocity of capital, like you're much better off to use the $8 million and put it into 8 different deals at a million apiece.
yeah.
Like your IRR and your money is just going to be so much farther compounded, than to put it in just one deal and let it ride for 10 years.
Yeah, absolutely. And the other thing about syndicating is you get paid to put the deals together, and so when you start looking at velocity of capital, what I've noticed over the last couple of years is, as long as I'm getting acquisition fees paid out from these properties, that acquisition fee is usually rolled into an investment in the next property, you know. And when I started out, I was kind of poor when I started out. I think I had enough money to to invest in my first two deals, and we had to waive the minimum for myself on deal number two. But as things have progressed, now these acquisition fees come in and it's excess. It's money that I don't need to use to live. And so the nice part about that velocity of capital is, we're taking the acquisition fee, the next deal we're doing, that's rolling in as LP dollars, and now it snowballs, it compounds. But
Yep. Snowball effect. Love it.
yes. All right. So a couple of syndications. What was the biggest challenge you had moving from, the self-purchase model? There's probably a better word for that, the DIY model to the syndicate.
I would say the largest hurdle I had to overcome initially was the deal structure, SEC attorney, PPM, that whole process. Underwriting a bigger property was different than underwriting a 20 in a property, a little bit different. But I had a pretty crappy model in the past. I had to use a better model. On that first syndication, didn't capital raise at all. So when I did my second syndication and capital raise, that opened up a whole different ball game of skills to learn, which I'm so glad I did that because I feel like capital raise is one of the best skills you ever have. That would be the largest mountain to climb, in my opinion. But on the first deal that I did, it was just learning how to put it all together, how to PPM and launch a deal and everything.
I agree. When I talk to people about, how to start out, I tell them to do exactly the opposite of what I did up front. What I did up front is exactly what you did up front. Found a deal, got under contract, and I thought I can't raise capital. Found a couple people to raise capital. I ended up raising about 400,000 for that deal, which was about 300,000 more than I ever thought I could. But, looking back at it, I think what you said is something that I've learned over and over again. Raising capital is probably the most important skill that you can have in this business.
I agree. We're similar both there. When I decided when something happened to where I knew I had to raise capital myself on the next deal, I formed Focus Capital and started with a 12 unit. I thought, I'll do a small one first. Let's see if I can do this. Can I get some buy-in from my family and friends, people that I know to trust me? I done 4 deals in the past, or 5 actually, one full cycle. And sure enough, I had to raise 300 grand, did it in 7 phone calls. And I knew right away that I can do this. That was last February of last year. And this is now May. We raised several $1 million last year. It was a grind, right? But it was a snowball effect now.
Gosh, I feel spoiled because I started, raising capital in 2019, 2020, and it was so much easier. Oh my
Lucky
goodness.
guys.
But now it's just like, I remember one raise we did, it was only like a $3.5 million raise, but this is how easy it was. Now, granted, we had to put a lot of work into building our investor list, but it was a handful of emails, a webinar, and then, okay, guys, portal's open. And, from the time we opened the portal to close a business that day, we had $3 million in the bank. I mean, $3 million committed. And a week later, we had $3 million in the bank. I mean, that was 2021 on that one. But once again, there was a lot of work and effort building that investor list. But yeah, now to raise the same amount of money, it's, I spent a lot more time on the phones. It's not just emails. It's not just webinars. It's phones and texts and
How it should be, though. This is how it should be right now. It should be building it through trust, credibility, track record, relationships. That's how it should be. And the people that do well at this right now will be doing very well going forward.
Oh, I totally on board with that one. So speaking of, I mean, let's talk where we are in market cycles right now. I mean, you're still buying. Why are you still buying right now when most of the investment world has decided to pause?
There's always times to buy. I mean, you can always find a deal to buy if it's the right basis, the right market, right business plan. I look at most deals to where if we're buying a deal right now for about $11 million, I think to myself, if I had $11 million in the bank, would I buy this deal? And I would. Yeah, I believe in it, right? I think they're a lot harder to find. We went through probably an average of an offer a week on a property this last quarter this year and this year so far. And we've got the best and final round about 4 or 5 times, missed it by just a sliver. So you ask yourself, how did I miss it by 100 grand? How did that really happen? I don't know. But you know what? We have criteria. I'm not going to budge and sacrifice an extra 300 basis points on an investor return just to get a deal, right? So they're hard to find right now. You can find some where, I mean, I've found most of my deals in the past through broker relationships, off
Hmm.
market deals. This one isn't the case, but yeah, they're hard to find, but I'm always going to buy because I feel like if you buy today's dollars, if the
Hmm.
basis is right, you lock in debt at today's dollars, your value of the dollar is going to keep going down. You're having inflation over time. You're paying off your debt within higher value dollars.
Yeah.
You can refi eventually when the rates go down, if they ever go down, but I think real estate is always a great buy. It always is.
Yeah.
I'm always buying.
I tend to agree, which is why I'm buying as well right now. You make some good points with inflation. Our dollars are going to be worth more late or worth more now. They're going to be later. So you're paying off debt with inflated dollars. I think a lot of people look at just the cap rates versus interest rates. And in most places, the cap rates are lower than interest rates. But I also think that's where a lot of apartment investors have been spoiled recently, it hasn't always been where cap rates and interest rates had a 2.5 point spread. But I think when you factor in inflation, now that spread between cap rates and interest rates, yeah, it's nice when you have a positive spread there, but when you start looking at the effect of inflation over time, I think that wipes away, a lot of that spread. And I mean, honestly, I'm buying at a negative spread right now on just about everything. But anyway, that's my 2 cents. I
I love
agree with what
it.
you say wholeheartedly.
We have all these new construction starts slowing down,
Yeah.
and there's still demand for housing. And I don't press the ball at all. I'm not sure what's going to happen, but let me tell you this. I feel like in a couple of years, when we have all these new developments absorbed and we have a
Hmm.
big slowdown and new development starts or products coming on market, what's going to happen to all of the current units on market?
Yeah.
More demand, higher rents. I think we're going to see another wave of rent increase.
Mhm. Yeah, and I mean Salt Lake, where I invest, is kind of like on the high end. If you look at the cities with the most deliveries this year, Salt Lake is top five. When they're doing deliveries like per capita on a percentage basis. But I saw an article recently saying that the building permits so far this year have been the lowest they've been in over a decade. So what you say is absolutely true. Yeah, we have a lot of properties being built, a lot of properties in the pipeline right now. But with permits being the lowest they've been in a decade, what's going to happen 2, 3 years from now? I think
Buy
exactly what's
right now, man. Buy them right now. Get ahead of the curve.
get ahead of that curve. And oh my goodness, speaking of getting ahead of the curve, I talked with somebody a couple of days ago that said they wanted to see a clear signal before they jump back in. They want the rates to start coming down. By the time that happens,
How about Blackstone buying $10 billion in assets? Is that a good signal?
yeah, I know. I mean, it's just man. And I saw a report Colliers has like almost $1 billion, ready to invest this quarter as well. So I mean, it's not just interest rates. There's a little more to it than just the interest rates. Yeah, interest rates matter, but I'm of the opinion that the money, it's the more money that flows into real estate, that's what's going to push the prices up. That's what's going to push the cap rates down. The interest rate is just going to help more money go in faster.
Yep,
But
I agree. I 100% agree. Yeah, rates are high, but in comparison, 7% rate today is what it's been averaged at
mhm,
over, a number of years.
yeah,
Yeah, they're high in relation to the last 10 years, but if the deal pencils out and we can lock in fixed debt, I don't really mind paying 7% on debt. I don't mind if we generate good returns because I know that real estate comes in waves, so do rates. If it doesn't come down, I'm fine. If it does come down, I'll be in the money even more.
yeah. One thing I'm trying to do on our acquisitions right now is make sure that I can refinance, So I'm not locking in 10-year debt right now. I'm trying to get loans that don't have a really hefty prepayment penalty.
Bank
So
deals.
one of them we're doing a Freddie right now, but we're buying down the prepayment essentially. So
Okay,
instead of
nice.
this 5 4 3 2 1, we're getting a 3 2 1,
Oh, that's
which
awesome.
yeah. So basically, for those listening, it basically means we don't pay as much when we refinance out. So it'll save us. It costs us an extra 20 grand to get the different pay down structure. But if we refinance in the first 3 years, it's going to save us, 50 or 60,000. So paying for flexibility on the back end, because like you said, I mean, you get fixed rate debt right now, and if rates come down, you want to be agile, you want to be able to take advantage of it.
I should clarify that we've done all bank deals so far today at fixed rate debt, and banks usually have no fee at all to go to agency to refi.
Right.
They're very flexible.
Yeah, I've done a lot of bank debt before, and we had one credit union in South Carolina that we just used over and over again. And if you look at a lot of the distress in the market, it's people who got bridge loans at variable rates. There's something about these banks that, if they can be flexible with you, a lot of times the bank deals are a lot better than the agencies. But we had one credit union that was giving us 80% LTV with, 80% of the renovations costs,
Yeah.
and
Yep.
if that was a variable rate, we'd be, underwater and we'd be probably close to default on a lot of the properties. But the bank gave us a fixed rate, the exact same term. So I love the bank debt if you can make it work out.
We got a bank to give us a fixed rate construction loan on a new development project we started this past fall. Fixed rate for 5 years.
Nice. What rate were you guys at on that one?
I want to say it's high sixes, 6, 7. I
That's
have deal merge. So
that's
something like
not
that.
bad. Here's the reality. I think you already said this, but my very first investment property, single family home. All right. It was in 2007 and we bought it as owner occupants. So we had a little bit of a break on the loan, but we were at 6.5 on that one.
Wow.
And I mean, I thought that was a good rate at the time because I remember my parents were paying, 10, 11, 12%, late 80s, early 90s. So
Good time to mention it's always good to check a lot of banks and credit unions and sources for loans. I remember my first 4 unit property, I was getting quotes for mortgages, and you probably know if it's a conventional mortgage or investment home, and more than 2 units or 4 units, they tack on all these fees on top. And back in 2021, home rates were about, I think, 3 or 4%. And I was going to pay between 6 and 7% on this 4 unit complex. And I went to local bank and they did a portfolio loan. I had about 30% down, but my rate was under 3%, 2.825 fixed.
yeah. Now, what I will say is the local banks, they can also turn on a dime, but if they have the appetite to lend on what you're looking at, you can get the best deals with the local banks. And I've talked with some of the bankers about it, and it's all a portfolio. They're looking at their own investments, so they're taking the note as part of their investments, and they're looking at their portfolio, and they want to make sure that they're well balanced, so if they're at a spot where they're looking at their portfolio and they've got too many single family homes on their balance sheet, a lot of them will be like, oh, we need more multifamily, or we need more, of this. We need more auto loans. We need more of this. And whatever it is they need more of, a lot of times they'll give you a really, really good deal to come in on it, So sometimes the small banks are awesome like that, where you can come in. I'll tell you, this bank that I was talking about that gave us the fixed rates, we were in the middle of a contract on another property and put our application in. They said, yep, we're going to give you the exact same terms, up to 80% LTC. And they said, but the rates are going to be a little higher than last time because rates are up. I'm like, yep, I get it. Rates are up. A couple weeks later, they came back and said, the president or somebody higher up in the organization said that we have too much multifamily on our books right now. So we're not going to do this loan. So there is the flip side to that. But if you can find a lender that the local lenders, I think a lot of those local lenders can really make some good loans for you.
I agree.
Awesome. So let's see. You're in Indiana. Are all of your properties in Indiana right now?
Yep, they are right now. Yes.
Awesome. Is that what you plan on doing for the immediate future, for long term? What's your plan on that?
This year for sure. I mean, Indiana's a great home base, great market, great for taxes, great for business. We have a lot of people coming here population wise. Steady Eddie, it's the Midwest. And right now, there's enough opportunity here in some great markets before we go out of state. I would say next year we will go out of state.
What markets do you think you want to chase out of state?
We're looking at Louisville, Kentucky, which is about 2 hours away from us. Cincy, Ohio, Columbus, Ohio. There's some Michigan markets we're looking at as well, and possibly to Memphis, Tennessee.
Yeah, all solid markets. Memphis, I know a lot of people who've been investing in Memphis. That's one that I've heard mixed stuff on, but I own something. I mean, we've got one in Columbus that's doing really well right now. Louisville's a beautiful city. I was there for a conference last year. I think most of those Midwest markets, you can't go wrong, and it's exactly what you say. It's steady, so they don't tend to appreciate as much as, like, I don't know, the Sun Belt did in the last couple of years. But on the flip side, when the Sun Belt's losing their shirts, Midwest is still steady Eddie.
Yeah, I think this year, or say last year, we still had a rent growth when a lot of markets had rent growth retraction.
Yeah. I mean, Salt Lake grew tremendously, but year over year, they were down in 23. And the latest report said that we're back in the black, back in the positive rent growth state territory. But yeah, I mean, it happened in a lot of spots. But if you're in one of those metros where rents keep going up, you're just sitting back, fat and happy. So yeah, fat and happy. That's what you want to be, right? So, but cool. All right. So, man, where's the time gone? I like to keep these episodes to about 30, and I think we've been talking for about 30 right now. So,
We're almost
I
there. Yeah.
know. Yeah, home stretch here. So, how about this? What's coming up next for you guys?
Well, right now we have that deal that we're going to be probably under contract tomorrow, is my guess.
Okay.
And we have a couple others in the pipeline that we may or may not get, but our focus right now is to, keep growing our investor base,
Mhm.
keep growing our acquisitions. Right now, we're a team of four. We're going to stay there for right now. We're going to absorb our payroll, our talents, and keep improving our operations. And then we're looking to potentially bring PM in-house later this year.
Nice. That's a big step. And I mean, we're looking at our numbers already, and I don't know when it's going to make sense to bring PM in-house, but yeah, we're looking forward to that one as well. I mean, we're underwriting deals and you're looking at that 3% management fee, and it's like, man, if we brought this in-house, that management fee is we're going to be able to trim that down quite a bit. So yeah, we're already looking at that spot. So let me know how it goes. I might call you up and bug you about, switching to, PM and how that transition worked. But well, awesome. So last question, well, second to last question, but the last important question, I guess. What advice would you give to somebody who is just starting out in the multifamily space?
I would give them two pieces of advice.
Okay.
Number one, I would not delay learning to raise capital for
Mhm.
real estate. I would not delay, this is more than one, I guess. But I would not delay telling your friends and family, the whole world, what you're doing. Because if
Mhm.
you wait 3 years like I did, or 2 years like I did, you've lost 2 years of them watching you along the whole way to get comfortable with what you're doing, to build trust, credibility. So that's number one. Number two is, I think what turned the corner for me was when I hired a mentor, hired a coach, worked with them.
Yeah.
They can see the blind spots, help you see ahead of the curve and limit mistakes. Not that you won't make them, but they hopefully will be fewer and you'll kind of pay for speed to learn faster.
Yeah.
Short learning curve.
That really helped for me too. Even though you do make mistakes, even after my mentorship period, we were the same, you were Michael Blanc, right?
Yep.
I remember
Yep.
that's where we met. But yeah, I mean, even after my 12 months, expired, it was just I would still pick up the phone on occasion and call my mentor and just like, hey, this is happening. What do you think? But yeah, having that relationship with somebody who has experience is totally worth it. And I think you and I both paid premiums for the program we were in, but having somebody to steer you clear of some of the landmines, or in my case, helping dig out of holes that you ended up digging for yourself, it's worth its weight in gold. All
I
right, last
agree.
question. How can listeners learn more about you?
Easy. One way, go to our website, focusedcapital.com.
Mhm.
I'm on LinkedIn here and there. So see me on there at Chad Schieler. Shoot me an email, shoot me a message. Let's keep in touch.
Awesome. And we'll put both of those, the link to your LinkedIn, link to your website in the show notes for people who are interested. And that's focused with a D, focused
Yeah,
capital.
plural.
I'm on the website right now. I was checking out some of your properties while you're talking about them. So, but yeah, he's got his properties. He's got some case studies on the ones that have come full cycle. So even if you're just interested in learning, head over to his website and you can see kind of the stuff he's been doing. So very, very valuable stuff up there. Chad, thanks a lot for coming on the show today.
Been
Very
great,
much
Brian.
appreciate the time, dude.
Yeah. Thank you for the invite.